Now, there are four methods of transfer pricing commonly used to influence taxes. These methods are comparable uncontrolled price, that's the CAP method, the cost plus CP method, the retail price RP method, and the transaction profit split PS method. These methods are discussed below. So please come along. Now, if you're enjoying it, don't forget to subscribe to my channel, like, share, comment. Let's go ahead. It's good to learn. The CAP, that's the comparable uncontrolled price method. This compares the price for property, goods, or services transferred in a controlled transaction to the price charged for property or services transferred in a comparable uncontrolled transaction in comparable circumstances. An uncontrolled price is the price agreed upon between independent parties for the transfer of property, goods, or services. If the transfer is in all material aspects comparable to the transfer between related parties, the price becomes a comparable uncontrolled price. There are two possible types of comparison, which are internal comparable uncontrolled price, where the price to the controlled transaction is compared to the price charged in a comparable transaction between one of the parties to the transaction and an independent person. And external comparable uncontrolled price, where the price to the controlled transaction is compared to the price of a comparable transaction between independent parties, both of whom are unrelated to the parties to the controlled transaction. The use of an internal comparable uncontrolled price is preferred because, relatively, the circumstances of the controlled transaction are likely to reflect more closely those of the uncontrolled transaction. Now, there are situations where it is most appropriate to apply the CAP method, and it includes, but not limited to, the following: where the price charged for the sale of listed companies, and also interest charged on borrowing between persons in a controlled relationship. There's also royalty charged on licensed intangible properties, for instance, trademark, design, copyrights, etc. Let's see the cost plus method. The cost plus method uses the cost incurred by the supplier of property, goods, or services in a controlled transaction. The cost plus method starts by computing the cost of providing the goods or services and adds an appropriate markup. In contrast, the resale price method starts from the final selling price and subtracts an appropriate gross margin to arrive at a purchase price. The cost plus method will use margins computed after direct and indirect cost of transaction, while a net margin method will use margins computed after operating expenses of the person as well. The cost plus, the CP method, is particularly useful in transactions between related parties, such as sale of manufactured goods, where the manufacturer does not use unique intangibles. Also, joint facility agreements on long-term buy and supply arrangements and provision of service. The resale price method. The resale price method is based on the price at which a product that has been purchased from a related party is resold to an independent person. This resale price margin is expected to vary according to the amount of value added by the reseller. Different situations can occur where the combination of functions, assets, and risk add value to the product. This can be illustrated as follows. If the reseller performs limited services as a forwarding agent or broker, the comparable resale profit margin may be derived from an explanation of commission or brokerage fees. If the reseller takes legal title in the goods, assumes the business risk, warehouses, and distributes them to customers, the resale profit margin applicable to the principal will be relevant. If the reseller, in addition to the functions and risk A, B, also undertakes marketing, education, and other activities, assumes warranty and other risk, and enjoys intangible assets such as a developed distribution network, the additional functions undertaking, risk assumed, and intangibles used should result in higher expected returns in line with that earned by independent resellers with a similar profile of functions, risks, and assets. The transactional profit splits, or the PS method, identifies the aggregate profits to be split for the related parties from a control transaction or transactions, and then splits those profits between the related parties based on an economically valid basis. The combined profits to be split are the profits combined earned by the associated enterprises from the control transaction under review. Factors to be taken into account in undertaking a profit split includes the following: whether the profit split is to be undertaken on a particular product line, an aggregation of profits, or a whole of entity basis. Whether it is necessary to identify the persons in relation to the transaction and the profits of each person so as to determine the profits to be split among them if the person transacted with more than one connected person, and also whether the accounts of the related persons need to be put on a common basis as to accounting practice and a currency, and then consolidated in order for the combined profit to be determined. The profit split may be undertaken on the basis of a projected or actual profit. If a profit split is used to establish the transfer price and as opposed to reviewing the transfer price, the projected profits will have to be used because the actual profits will not be known at this time. If there were variations between projected and actual profits, the person should make appropriate adjustments when reviewing its profit splits projection for future years, if and on the basis that independent parties might be expected to do. Now let's pause as you subscribe, like, comment, and share. Let others to benefit, and also drop your comments. Tell us more what you want to add and all that. It can also be splitting using a contribution-based analysis. Splitting profits on the basis of a contribution analysis means that the aggregate profits from control transactions are divided between the participating connected persons based upon the relative value of the functions performed, assets used, and risk assumed that each of the connected persons participating in those transactions, supplemented by external market data that indicate how independent persons would have divided profits in similar circumstances. We also have splitting using a residual analysis. Splitting profits on the basis of the residual analysis involves the division of the combined profits from the connected persons transactions using a two-stage approach. Each participant is first located sufficient profit to provide it with a basic return appropriate for the type of transactions in which it is engaged. The basic return will be determined by reference to the market returns achieved for similar types of transactions by independent persons. To be able to determine the arm's length price of a product transferred among the group, we may consider the characteristics of the product or services, the functional analysis, that is, the functions performed, assets used, risks assumed. We may consider the contractual terms, for economic circumstances, 5 business strategies, perhaps the industry, and there are a lot to consider. Now, B says list the controlled and non-controlled transactions among the group, the subsidiary, and state their relevance in determining the arm's price of transferring the smartphones among the group. Controlled transactions is after the acquisition of Hollis SA. Consider sale of finished products by Spartek Company Limited to Hollis SA and buyback by Spartek Company Limited of unsold stock from Hollis SA. Manufacturing by Smartphones of Spartek Company Limited. The uncontrolled transactions, sales of finished products by Spartek Company Limited to Hollis SA Company before the acquisition of the latter by the former. And sales of finished products by Spartek Company Limited to other uncontrolled distributors, if any. Sales of products by the Spartek Company Limited to Ghanaian customers. Purchases of finished products by Hollis SA Company from independent suppliers, if any. Okay. Sales. Then we have sales transactions between other suppliers and independent distributors. We have manufacturing by Hollis SA for independent customers, if any. Manufacturing by independent manufacturers for Spartek Company Limited, if any. It's the VII manufacturing by other manufacturers for comparable independent phone companies. The relevance of analyzing the controlled and non-controlled transaction is to determine whether they are to the extent that comparable uncontrolled price method or other transfer price method will be appropriate in the circumstance. Again, the relevance of analyzing the controlled and non-controlled transactions is to determine whether they are comparable to the extent that the comparable uncontrolled price method or other transfer price method will be appropriate in the circumstance. Also, analysis will determine the tested party to the transaction. Now, see what was there. We asked from the information available to determine whether it will be appropriate to use a comparable uncontrolled price, that's the CAP method, to arrive at arm's length price. Now, transactions. Sale of smartphones by Spartek Company Limited to the Hollis SA. Applying the CAP method, there is a comparable uncontrolled price to this transaction. That is to compare the price at which Spartek Company Limited sells products to the Hollis SA with the price in a comparable sale between independent parties. There is information on the sales of products by the Spartek Company Limited to the Hollis SA in 2015. The uncontrolled sales and the functional analysis of the parties were the same in 2015 as in 2016. However, there were sales of different models. The phone model changes every year. These differences in product characteristics means that it is not possible to compare the price of the product sold by a Spartek Company Limited to the Hollis SA in 2016 and the price at which they were sold in 2015. It is not possible to make a reasonable, reliable adjustment to eliminate the difference between different models of phone. Therefore, it is not possible to use the CAP method for these sales. Also, there is information on sales of products by the Spartek Company Limited to Ghanaian customers. These are likely to be sales of the same products as the one sold to the Hollis SA during the same period of time. As such, the comparability factor of product characteristics is likely to be satisfied. However, in terms of functional analysis, sales to Ghanaian customers cannot be compared with sales to the Hollis SA. Again, it does not seem possible to determine a comparability adjustment to eliminate the differences in functions, assets, and risk involved in these two transactions. Therefore, on the basis of the information available, there is no comparable uncontrolled price or cap to apply. The tested party should be less complex party to the transaction. That is, or let's say, in the absence of a cap, the resale price method or a TNMM, that is net margin on sales, will be appropriate. The gross or net margin earned by LSSA from its distribution of smartphones will be compared with the gross or net margin earned by a comparable uncontrolled distributor. If the economic circumstances are stable, it will be compared with the gross or net margin earned by the wholesale SA from its distribution of smartphones until 2015, that is, at a time when the two companies were not associated. Alternatively, the gross or net margin earned by comparable independent smartphone distributors in the Netherlands could be used as a benchmark. We go to the II transaction. Manufacturing or products by Smarting for its parent company, the Spartek Company Limited. The tested party should be the less complex party to the transaction. In this case, Smarting, the Chinese manufacturing company, is the tested party. Based on the available information, there is no cap because the same models of smartphones are not manufactured by any independent manufacturer. The cost plus method or TNMM, that's the net margin on cost or net margin on assets, will be appropriate in the circumstance. The markup on cost or net margin earned by Spartan from its manufacturing of smartphones should be compared with the markup on cost or net margin earned by comparable uncontrolled manufacturers, presumably independent Chinese manufacturers of smartphones. Now we look at illustration 2. Western Minerals Limited, a company is the Ghanaian resident company, and Gold Resources International, the South African Western Company, are 100% owned by Mineral Investments, a multinational company resident in Mauritius. Western Minerals Limited mines gold in the Western and Ashanti regions of Ghana. Gold Resources International refines gold as its gold refinery in Johannesburg, South Africa. Western Minerals Limited sells their own refined gold mined in Ghana to Gold Resources International. Gold Resources International refine the gold and trades the refined gold on the spot markets and forward exchanges. Besides, Gold Resources International buys unrefined gold from other unrelated parties, as other unrelated gold mining companies in South America. Western Minerals Limited have reported losses for the last 5 years and therefore pay no corporate tax to Ghana Revenue Authority for those off-tax assessments. With the promulgation of the Transfer Pricing Regulation LI 2188, the management of Western Minerals Limited decided to engage a transfer pricing specialist to advise them on how to determine the transfer price of the unrefined gold they sell to the Gold Resources International. As a transfer pricing specialist, you have been engaged by Western Minerals Limited to advise them on transfer pricing issues. The term of your engagement requires that you prepare a preliminary transfer pricing report on how to determine the transfer price of the unrefined gold the company sells to Gold Resources International. This preliminary report must be submitted to the management of Western Minerals Limited within 1 week of your engagement. Required: prepare the preliminary transfer pricing report on How to determine the transfer price of the unrefined gold Western Minerals Limited sells to Gold Resources International. Transfer pricing report on Western Minerals Limited. 1. Transfer pricing risk analysis. The following issues may trigger transfer pricing audits. 1. Western Minerals Limited resulted in a negative profits. That's Western Minerals Limited reported results for 5 years which are negative. Then the sale of unrefined gold by Western Minerals Limited to its related enterprise, Gold Resources International of South Africa. There is also controlled transactions. That's 1. The sale of unrefined gold by Western Mineral Limited to its related enterprise, Gold Resources International of South Africa. Then also refining of unrefined gold purchased by Gold Resources International from Western Mineral Limited. Furthermore, there is also the sale of the group's refined gold on the spot market and forward exchanges by Gold Resources International. We also have uncontrolled transactions. The purchase of unrefined gold from unrelated gold mining companies in South America. Also, the redefining of unrefined gold purchased by Gold Resource International from unrelated mining companies in South America. Finally, sale of gold from independent sources on the spot market and the forward exchanges by Gold Resources International. 3. Comparability analysis. In terms of characteristics of products or services, Western Mineral Limited deals with unrefined gold, then Gold Resources International has refined gold. Functional analysis. We have the functions performed. Western Mineral Limited mining gold, and Gold Resources International, the refining of unrefined gold and sale of refined gold on the spot markets. You also have the assets employed, whereby the Western Mineral Limited has gold mining machinery. Then the Gold Resources International, they deal with spot market and forward exchanges. And let's see the risks assumed. We look at other risk, credit risk, foreign exchange risk, political risk. And the same applies to Gold Resources International, where we can also look at credit risk, political risk, foreign exchange risk. In contractual terms, Gold Resources International has a contract for forward exchanges, but that of Western Mineral Limited was blank. And economic circumstances or other business strategies, both of them left it blank. Now, choice of method and tested pricing. The 3 traditional methods of transfer pricing are appropriating and ranked as follows. There are unrelated gold mining companies in South America who sell unrefined gold to Gold Resources International. Therefore, the comparable uncontrolled price, that's the cap method of determining the arm's length price for the sale of unrefined gold by Western Mineral Limited to Gold Resources International, may be appropriate when the conditions underlying the transactions between the South America companies and Gold Resources International are comparable to the transactions between Western Resources Limited and Gold Resources International. If the situation is as much that the cap method may not be appropriate, then the cost price might be considered. The cost price may only be considered in the arm's length of mining the gold and the arm's length gross profit markup could be ascertained. The tested party in this situation would be Western Minerals Limited on Ghana. Also, when the circumstances are such that both the cap and cost plus methods are not appropriate, and the resale margin method may be considered. The use of the resale price margin method may only be appropriate in this circumstance if there are independent gold refining companies with similar business models whose margins could be used as comparable. The tested party here would be Gold Resources International. Now, how to obtain comparable? The use of commercial database as follows for calculated data from other independent full-service operators with similar business models. Also, the annual financial corporate returns of Gold Resources International and its South American clients. Also, look at cost plus method, which determines ounce length cost of gold mining by Western Minerals Limited and apply the gross profit markup of independent gold mining companies in Ghana. Then finally, for resale price margin method, comparable margins earned by gold refinery and marketing companies with similar models as Gold Resources International.